Even if you have $1 million in the bank, getting a home loan can still be a challenge. But planning ahead can make a big difference. Today, we're sharing our best advice for buyers looking to get a mortgage, from common mistakes you can avoid to questions you should ask your lender.
Welcome to Elevate, where we explore the latest in elevated living. Hear from the local artisans, business owners, and innovators that make Las Vegas extraordinary, and whose stories and insights will help you live your best life.
This is episode 4 with Michelle Massa, Senior Mortgage Loan Officer at Nevada State Bank. So Michelle, tell me about your background in the mortgage business.
Well, it feels like a long one. I actually started in banking back right out of college and essentially fell into mortgage. Little old lady did a home equity loan for her because that was my specialty. And she proceeded to tell me that her son was a loan officer and wanted to come in and review my documents. So I kind of rolled my eyes and said, that's fine. And he came in, and by the end of the signing, he actually offered me a job in mortgage. And from there, that was about 20 years ago. So been in Las Vegas the whole time. I basically have always worked for banks just because I felt like it was more where my comfort zone was. I felt like it was a safe environment, and there was, retirement and all that kind of good stuff. But ultimately, I started into private mortgage banking about 14 years ago. And since then, really have specialized in the high net worth, self-employed, more affluent clientele. I do everything, but really have developed a niche for clients who are self-employed, and I can analyze taxes. And so with that, now I usually average anywhere to 50 million to 60 million a year in production over roughly the last 4 years. So it's really extensive.
Exciting. And just to give everyone a little more background of how I've known you, it's been quite some time. I'd be curious to figure out how and when we actually...
I know it was at Wells Fargo where I worked when we first started working together, and that was at least 10 years ago. So I think you and I have a good probably 12 years would be my guess.
And one of the things, one of almost my complaints, not for you, but just in general, is...
It's okay, you can complain about me.
Is that it's not that often I actually refer people to a lender, because I feel most buyers that are in the high-end market, when you're talking about jumbo loans and whatnot, is they're business owners or they're professionals, et cetera, and they have their bank or their private banker, and they sort of feel like, I've got my connection, I've got my person.
Right.
And usually there's a little bit of blood dripping out from me biting my lip so hard, because I just know what's going to happen. And the inevitable is that usually it just always has problems. And that's why it's been nice to work with you, because you always have saved the day when, whether it's just from doing it right from the get-go, or have had plenty of clients sort of jump ship in their current situation, and you've jumped in. And why is that you think that these folks that are people that, they've got millions with particular banks, you'd think they maybe get some special treatment, but it sure doesn't seem like it.
It can be tough. It can definitely be whatever said lender. But I would also say that if I can help clients understand anything, it's that don't be afraid to tell me the worst stuff. Don't be afraid to give me the deep, dark secret at the back of your closet, because a lot of the times they might have millions of dollars and they might have that relationship. But if there's a secret that we don't know from the beginning, we don't know how to solve for it, we don't know how to fix it. If we get to that last minute, 9.9 times out of 10, an underwriter is going to catch something, and it's going to make everybody upset, because it always happens at the last minute. But really, people are so afraid to tell you what it is, when in reality, it's something we can fix really easily most of the time. But that being said, there are definitely something to be said for, I work for Nevada State Bank now, and we have a phenomenal portfolio where we can make those exceptions. And that's part of the way I'm able to save the day, for lack of a better term, is we keep that money on our books. We keep that loan on our books. We have our own underwriters. We make the decisions, which means that maybe you, didn't file 2 years of your taxes, and now you're suddenly like, hey, I want to qualify for a loan, but I haven't filed my taxes for the last 2 years. If you tell me that, I'm going to say, great, go file your taxes quickly, and then, give me some information. We can still get the process going. But it's those I guess the hard thing for a lender is when somebody thinks that we should be able to fix everything without a problem. Like everything, you can just do it. I have $1 million in the bank. You can just do whatever you need. And it doesn't work that way. We have compliance is a whole other horrendous topic we could get into. But it's tough. Mortgage is tough these days, but the more honest you can be upfront, the way better off you are. Tell me your worst case scenario. Tell me your deep, dark secret so that I can fix it.
Is there, other than people not filing taxes, is there any other sort of common things that people forget about? Or
Oh yeah. The big one, when you're self-employed, I get it. You do not want to pay any more taxes than you have to, so you're showing as little income as possible on those business tax returns. Please understand, I have to use the numbers that are on those tax returns. So if you want to go buy a $2 million home and you're only putting 20% down, you can't show $10,000 in annual income for the previous year. It won't get us anywhere. So that is probably one of the biggest things that is so hard, which is why I'm always trying to ask people, don't tell me how much you made, tell me how much you showed, because that's really the nuts and bolts of what we have to work with. And if we don't have enough there, we can get creative with assets and various things to try and make up the slack. But income on taxes, please understand income on taxes is what we use. Tip income. We live in Las Vegas. I mean, that's a big thing that people get tips. If you don't report them on your taxes, I cannot use it for income. And that's a big piece of income. So it's a tough one. It's a double-edged sword. I totally understand why people don't want to show that income, but at the same time, I can't do anything for you.
Gotcha. Just a quick clarification point. What's the jumbo loan cutoff point
These
today?
days, as of today, it changes every year. At least it has been. 647,200 and under is considered conforming. So 647,201 is considered jumbo, which is crazy. They actually increased it almost $100,000 over last year's number. So it's just, but every year in January is when they evaluate it and increase it usually, or decrease if it is going that direction. So yeah.
Got it. Well, and coming back to just talking about getting to those deep, dark secrets and ultimately just getting pre-approved.
Yes.
Is it's always, not always, but it can be a struggle at time in the luxury market or any market, getting people to go there and get qualified, because most folks, it's more exciting to look at homes
for sure
before doing math and taxes.
For the hard stuff.
I mean,
the hard stuff.
Exactly.
No one likes the hard stuff.
And secondly, most folks, when they do have the $1 million in the bank or they've got a good income, et cetera, like to them, they just, hey, it's no problem. Of course I can get a loan. What's the big deal?
Right.
And they just don't realize that, like, there might be this your debt to income ratio, or you don't have like 2 years or
forgot I co-signed for a kid on a car, or didn't realize that this other lease that I turned in a year ago didn't actually pay off on time. Or there's so many things that come up that, like you said, people think that everything's fine, but until we actually dive in on that pre-approval and look at what we have, yes, it saves, again, time, hassle, stress in the beginning if we can do that, if we can have that conversation early and go through income.
Yeah, and like fill out the application. It's just like, I know so many people are just like, it's this pre-qual where it's like they get their credit pulled and they, say, and I make X, and then they get a letter sent over so they can go make an offer, go look at homes. And hey, if you're in a rush to get out and get the ball rolling, that's what you need to do.
Right.
But it's like the sooner you can get that application in, the sooner you're going to also just set yourself up for success, because once you negotiate a deal and now you're spending money on inspections and appraisals, like last thing you want as a buyer are those surprises.
Well, that, and one of the other things that people don't realize is, I get it, no one wants to deal with the hairy pre-qualification, but just like most things, it's getting more streamlined. It's online. You can do it at the convenience of your home from your phone if you want to. It's a usually only 10-minute process. It's really much easier than people think. Yes, we do have to pull your credit to have it be valid, but, and again, I'll speak for Nevada State Bank because I can't speak for other lenders, but our credit reports are good for at a minimum 90 days, sometimes 120. So we might never need to pull your credit again when you find a home.
Right. And what do you say to the people that think pulling their credit's just going to sink them? Like, I feel they're just so concerned that you pull the credit, they're going to now never qualify for anything again.
Right. I mean, generally 3 points, it might impact your credit score by 3 points, 3 to 5 points. However, not that you want to do it, but if you're going to go shop loans, if you pull your credit, you could pull it 20 times in a 10-day period. As long as you do it all in that window, it's only counting as one ding. So that's something to know too. If you start looking, then do your looking all at one time with your lender so that they can all be hitting it and you're not taking the impact of that brunt of the inquiries. As a lender, one of the things that does come up though, some people have heard the adage, or you see these memes or jokes about it, where don't go buy a new car when you're in the middle of buying a home. Don't go open a credit card. it's true. And for that reason, one of the things that a lender looks at right before we're closing a loan is the inquiries on your credit. They'll do what we call a soft pull. Doesn't impact your credit score, but they will look and see what kind of inquiries have happened on your credit since we started the application. And if we can see Finley Chevrolet and Audi and all these different inquiries, we're definitely thinking that you went and bought a car. But if you really, we just have to reach out, hey, we need an explanation for what the inquiry was for and if any new accounts were opened. And hopefully it was I was shopping for my kid, but no, we didn't do anything. But worst case scenario, don't think we won't find out. We always find out. So pre-qual up front definitely makes it easier because then you're going to just avoid the big bad wolf halfway through the loan process for sure.
Well, and then getting things like sprung on you as well. I think you mentioned there was a story. It wasn't a loan you were doing, but someone that got surprised with a big bank.
Oh, I again, saving deals. It's one of those, I work on saving these deals, but a lot of the times I had a recent client where, and I'm so grateful to him, but I definitely have relationships with mortgage brokers as well. Sometimes it's a deal that I cannot do, so we refer business back and forth. That being said, I actually had a broker call me recently, and he was like, hey, are you doing the 10-year ARMs right now? I said, absolutely. It's one of our best products. And he said, what's your rate on it right now? And I told him the rate, and he's like, you got to be kidding me. And I said, no. And he's like, that's incredible. And I said, well, great. And he's like, I'm about to lose a deal to a big bank who's offering something lower, but you're offering lower than he is. So if I'm going to lose it, I'd rather lose it to you. I'm like, fantastic. I'd rather take it for you. So the big banks can spring things on you and think that they're doing the right thing for the client. But again, if you as a client, now this guy, awesome, because he does have that sense of, I want to do the right thing for my client. And so he did search out to find a better deal, which is great because the client already thought he was getting a good deal. He had no idea that there was a better deal even out there. But that being said, it's one of those due diligence reasons of why you, as the borrower, I know it's scary and I know it's overwhelming and I know there's a lot of things that you might not know, but don't be afraid to ask the questions because at the end of the day, you need to feel this is a massive purchase. I don't care if it's $100,000 condo or if it's a $5 million home. Like it's a lot of money for whoever's doing it. And it needs to be something where you feel comfortable with the process. And there are people who have done this 10, 15, 20 times and they know it inside and out. But there's others who have done it once and then they haven't done it in 20 years and a lot changes. And so if you can't feel comfortable asking the questions, you'll never know what you may or may not be missing out on or need to know for the next time or to help you through this process to make it easier. I think that a lot of the time mortgage gets such a bad rap about it's such an awful experience because sometimes it's the blind leading the blind. So you've got somebody who isn't really familiar with guidelines or what's required, and you have a borrower who's never done it before. So they don't know what questions to ask or what information to offer. So just open dialogue, open conversation.
Right. And I would generally, I would recommend, I'd caution people about just shopping for the best interest rate on the internet because a lot of times those lenders end up being out of state and they might overpromise and then underdeliver and now they're nowhere around. You can't sort of go show up on their doorstep.
Exactly.
And it just, so that's just something I've dealt with myself as a real estate agent is clients that have found some dream, rate, and it's the loans being done out of Ohio or somebody out of state. And it doesn't mean it's not possible, but they don't have the local connections with their AMCs and whatnot. And there's just, and then all of a sudden there's no branch office to go show up at or deal with. So I just really caution about
the other things to be aware of when you're shopping rates on the internet is they're probably charging you some kind of point to get there. This is a catch rate. They're offering it in big letters because they want to reel you in. And then usually it's a very small time or very small percentage of people who actually qualify for that. And if they do, they're probably paying points to get there. So it is the way that they get business to get somebody in. And then they're like, oh, sorry, your credit score is not good enough for that rate, but we can do this. And by that time, you're already reeled in because they've pulled your credit or whatever they've done. And so you feel stuck. You're never stuck. You always have options.
Just remember the cautionary tale of Hansel and Gretel.
Yes.
That could be you and your
There
loan.
you go. Don't be Hansel and Gretel. Don't want to eat all the candy. It's definitely... And my biggest thing that I would tell people, to be honest, is check with your banks. Check with your broker, but check with your banks. I don't care who your bank is, but check with your bank because people don't always remember that the banks have that offer. And because we're regulated at a different level, oftentimes our fees are lower and our rates are lower.
So jumping into the current loan environment, it's June 2022, and the Federal Reserve has been raising rates, and they plan to do more of it. When the Fed raises the rates, how does that affect mortgage rates?
So people often think that, the Fed just raised the rate 0.25%. That means mortgage rates are going to go up 0.25%. It is not that way for your traditional mortgage. When the Fed raises rates, it's anything variable. Credit cards, home equities, that type of thing. Mortgage rates are impacted by the Fed increasing them, but the bigger or better way to have an idea of what mortgage rates are doing is to watch the 10-year Treasury. If the 10-year Treasury is going up, it means mortgage rates are probably going up. Again, not directly, but it's a good indication of what direction they're going. So lately, the 10-year Treasury has been over 3, which is, I think I heard, don't quote me, but I want to say it was 2018 was the last time we had the 10-year Treasury was this high. And so essentially everything, yes, is cyclical. But at this point, the reason we're seeing those mortgage rates continue to rise is really because the Treasury has continued to rise. Inflation is going up. Everything is increasing. So Fed increasing rates does have an indirect impact on mortgages.
Got it. Now, with regards to during COVID and sort of all the different stimulus and release, like people were able to stop making their payments for a while. What happened to those people?
I got to tell you, I sometimes think that we're doing more damage than good. But in reality, there's so many things that I get it that we want to create opportunities for people to alleviate some stress or to alleviate some financial hardships. And I think that is important. But the people who took advantage of that, thankfully, by now, they're probably through it. And what I mean by that is the standard was a 90-day deferment of payment. Every bank kind of did their own thing on how they wanted to handle it. Some created a second mortgage for that 90 days of payment. Some just added it to the back end. But our general rule, what we looked at for those people was once that 90-day of deferment was over, as long as we could show that they had made at least 3 payments on time after that, then it was like it never happened. It didn't report on credit, or at least it wasn't supposed to, but ultimately we did need to see that they'd had at least 90 days of on-time payments after the deferment period. So it was a blip. It wasn't anything crazy.
The deferment period was only 90 days? I thought it
For most. Every bank is different. Like I said, some could do longer. And even if it was longer, ultimately the rule was 90 days of payment after your deferment ended was what we needed to do. So if, I don't know, let's say you were with a bank that allowed you to defer for the last 12 months, as long as the last 3 months you've made your payment on time, or don't go shopping for a home until the next 3 months is over and you start making your payments on time. But that is the general rule. It really wasn't a horrible impact the way we thought it was going to be.
So is that, as far as to the best of your knowledge, has that sort of all been resolved? Doesn't mean there aren't people not making payments, but in terms of that 90-day window,
Yes.
I'm assuming that's all come and gone.
Most people, it was a 2020 thing. Most people got through it by 2020 at the latest. I definitely have not seen it this year at all. So it's kind of one of those, I don't want to say it's like the HARP loans, but all these different things that we try to put in place at that moment to help at that moment. It did its job. It helped some people.
Perfect. What else are you seeing out there in the world of mortgage these days? Anything people should know about?
The thing that I think is important for people to understand and realize, and I know, Rob, you and I have had this conversation a couple years ago, actually, when rates had kind of gone up a little and then came down, is obviously with interest rates increasing, it changes your buying power. Whereas, 6 months ago, you could have qualified for, let's just say, $1 million home purchase. Today, because of where the rates are at, that might be $750,000. It changes. If you need your payment to stay the same so you qualify the same, then you have to change your loan amount or increase your down payment, or those numbers all flow together. They ebb and flow. So it just depends on what you're really trying to get done, and you need to pay attention to that. But really the big thing, and I am a big fan of ARM loans. I know it's crazy. It's the taboo. Everyone thinks it's nuts. But in reality, if you can have someone educate you on the way an ARM works, and you can make sure that it is conservative, for lack of a better term, and safe, for lack of a better term. I mean, I don't know. The last statistic I heard was the average person either moves, sells, or refinances every 5 to 7 years, which means that if you can get into a loan where your interest rate is fixed for at least 7 or 10 years, then your payment is going to stay the same the whole time you're in that mortgage. And side note, you can still refinance at any time and get out of it if you want to. So the reason why I bring it up is Today, a 30-year fixed standard conforming $647,000 mortgage for somebody with good credit is probably hovering around 5.375. No points. Whereas an ARM loan, we offer a 10-year ARM loan as of today. Granted, it's going up on Monday, but as of today, we could do that exact same thing. Granted, it's only fixed for 10 years instead of 30 at 4%. That's 1.375 difference in an interest rate. When you're up in that $1 million arena, especially, that's $500,000, $600,000 a month that you're saving. It's still principal and interest. You're still paying down your mortgage.
Oh, sorry. Let's start. I think you said 500, 600,000 a month.
I'm sorry, $500, $600 a month.
Gotcha.
My apologies. Big difference there. But $500 to $600 a month, again, it depends on your loan balance. But you're realistically talking about a substantial savings on a regular loan that is principal and interest payments. So your loan balance is decreasing every month, just like if you had a standard loan. It's a 30-year amortization, just like your standard loan. It is literally apples to apples as a standard loan, with the exception of after the initial 10-year period, the interest rate could adjust. So if you went into it knowing, hey, I'm just going to plan to refinance before my 10-year mark, then you're safe, you're good. And the only way your payment can change is if your property taxes or your homeowner's insurance changed. So that gets you back at that buying power of the $1 million wherever you were originally. So don't be afraid of the ARM loan. Ask the questions. Is it interest only? A lot of people don't like that because obviously their balance is never going anywhere. Do I have a prepayment penalty? Prepayment penalty. Sorry, I wanted to make that very clear. These days, I'll admit, I still haven't heard of anyone making this. We are seeing some things start to mirror and start to look eerily similar to back in 05 and 06 and when they were doing some pretty shady things. But so far, it's very rare if you see a prepayment penalty. And as long as there's none of that there, it's probably okay. But ask multiple people so that you can make sure you're knowing the right questions.
Got it. The speaking of just some general questions, what is a good faith estimate?
Well, I'm going to throw you under the bus a little bit and tell you they don't exist anymore.
Oh my goodness.
Realistically,
Lies.
the government just keeps changing things. They think they're making it easier, but sometimes I feel like they're making it harder. These days, that same document, if you will, is now called a loan estimate. It's probably 3 times as long as what a good faith estimate was. So now it's lots longer. But essentially, it is a document that is really it's one of the most important things as part of your initial disclosures on any loan, and it should be disclosed to you multiple times throughout your loan. Basically what it is it tells you everything about your loan. It tells you the terms, tells you the rate, tells you the payment, tells you if your property taxes and homeowner's insurance are included in your payment or separately in your payment, tells you the fees you're being charged, tells you how much you need to roughly estimate on bringing to closing, tells you if you're paying points on a loan, tells you everything you need to know is summarized on that document. So it's really important to go through it and understand it.
And I have another question about that, but really quick. So the good faith estimate also used to be referred as like the GFE. Does the loan estimate have its own?
Ellie.
It's just Ellie.
Go figure. Yeah. Yes. We're very creative these days in our acronyms.
Bunch of bankers.
I know.
So anyways, my experience has always been that a lot of lenders were always a little reticent or didn't want to share these good faith estimates or loan estimates because it was an easier way to sort of for them to be shopped around. Like by putting all the terms, everything in writing, it was easier to take that around to show it to different people and say, hey, can you beat this? Can you beat this?
Sure.
Is that something that's still maybe out there? I mean, people not really volunteering to, because they'll maybe obviously draft that loan pre-approval letter, but maybe not go out of their way to say, here's your loan estimate. That is until there's a signed contract and they're in escrow. True.
I mean, realistically, what I would tell you, if somebody's afraid to tell you what their fees are, what their terms are, that's a big red flag. While I would tell you that once you're in contract and you're actually in that deal and moving forward, by law, any lender has to disclose that to you within the first 3 days. So you'll have to receive it and you'll have to get it. Very rarely do people give out a loan estimate on a pre-approval. They can, but again, there's just so much that changes with it because of the fact price changes, taxes change, everything, and it's all included in that information. So my better thing that I would tell you is have somebody tell you what their clients' fees are. What are the bank's fees that you're charging me? Because to keep in mind, it doesn't matter what bank you use, the title company's fees are going to be what they're going to be. Those other fees, commissions paid or broker fees or whatever those things are going to be there. But if you ask whatever lender you're working with, what are the fees you charge? That's a very direct question that they should be able to tell you very easily.
Right. And I think to expand upon that, which I'm sure you definitely can, is that first of all, buyers / borrowers need to understand, like, yeah, it's okay for these people to make money. Like, that's their job. They're absolutely going to make a fee.
Right.
What the borrowers maybe don't realize is the lender could give you a better rate or a lower rate and maybe charge you, like, they might be able to charge you no fees, but give you a higher rate,
Right.
or higher fees and a lower rate, or
Right.
a combination thereof. So that's where the loan estimate comes into play when you're trying to compare apples to apples,
Yes.
because you might get this lender over here that's giving you a half point better, and you're like, oh
Right.
my goodness, like, I got to go with this person.
Right.
But if you looked at their loan
Bottom
estimate,
line.
you're going to see like, oh wow, but they're going to hit you with some extra fees.
Yes.
Where someone might say, oh, but you should use my lender, they don't charge you any fees. But now all of a sudden they're giving you a higher rate, or you realize, like, wait a minute, it's not a higher rate, but instead of a 30-year mortgage, it's the 10-year ARM. And
Right.
maybe that's okay with you, maybe it's not. So
Right.
there's all these different levers that they can pull.
Yes.
And by like getting that loan estimate, preferably up front before you're in contract, so you
Yes.
understand.
Yes.
Because as a borrower, remember, when you're buying this house, you have to come up with your down payment.
Mhm.
You've got to come up with some out-of-pocket money for an appraisal, home inspections,
Yep.
etc.
Yep.
I mean, look, you're going to have to move also,
movers.
and deal with that. But then there's also prepaid, impound account.
Yeah.
What's really quick? Let's finish this
The impound
loan
account?
explanation. Yeah.
Well, I mean, you're definitely spot on everything you're saying. And just because I love to throw out our banker terms, because
Mhm.
we're really cool and special with our banker terms, we refer to that as premium pricing, the way you're talking about if you charge a higher interest rate and give them a credit back. It's just, like you said, it's a matter of, it's a shell game. Where are you
Mhm.
moving the numbers to? But ultimately, like you said, if you ask the question, I would like your estimate up front. I would even tell you, yeah, if you're not in contract yet, it's kind of a pain, but I could do it. I could give it to you. And you have every right to know exactly what it is that you're getting into. Because like you said, there's a lot of people in the lending industry, unfortunately, that are not as upfront, and they know that they might be doing something that you might not like. And I know this is really shocking, but no one likes to deliver bad news. And they really just want to keep the client happy. So they're like, oh, maybe I'll just slide them into this ARM loan, and they won't even notice that the program is different because I still got them the rate that they were looking for. You definitely have to look at all of the information.
Yes. It can be a little dry, but
Yes.
you
Oh,
just,
it's super
you just
dry.
gotta do it.
Go to bed at night.
So when it comes to refinancing, I'm involved on the purchase side of
Mhm.
things. Are people doing that these days still, now that rates are going up?
The thing that we are still seeing, I mean, don't get me wrong, the refinance boom is definitely over. I mean, I think they've said that mortgage applications have dropped off like 40% across the industry for the most part. But there are still refinances happening on the flip side because of the fact values being as high as they've gone up. There are people who have decided, you know what, I'm just going to cash out of my home. I'm going to take equity out of my home and pay off debt, or go buy a second home, or buy a new car, or whatever that might be.
So which is better, a cash out refinance or a home equity loan?
So they're definitely different things. And I guess I would tell you, the first question I would ask a client is, what is your goal? Anytime a client tells me they want to refinance, I'm like, what is your goal? Because if somebody says, oh, well, I'm going to do a home renovation and I don't know exactly how much I'm going to need, but I want to make sure that I have it available, home equity line of credit is definitely your best option. Home equity loans don't have any upfront costs. And if they do, you need to find a different bank. But they don't have any upfront costs. So that's super attractive. In addition to that, they work like an open-ended credit card in the sense of you can use it, pay it back, use it again, pay it back. And that's usually for up to 10 years, you can use it like that. Interest rate on the downfall is variable. So just like a credit card, and just like we kind of talked about, when the Fed increases rates, your interest rate can go up on a home equity loan or line of credit. I apologize. Their other option is a home equity loan, which is more like a second mortgage. I don't want to go too deep into the weeds here because, it gets to be a lot. But ultimately, home equity, the best way to avoid it is if you want money to be able to use, but you don't really need it yet, home equity line of credit is probably a better way. If you're like, hey, I know I need to put a pool in my backyard and landscaping, and I'm going to do some renovations, and my budget is $150,000. Cash out mortgage is probably a better option for you because you can take it all, roll it in. Second mortgages, whether it be a home equity line of credit or a home equity loan, traditionally have a higher interest rate than a first mortgage. And the simple thought process behind that is they're in a worse position from the bank. It's a bigger risk, if you will. So the bank is going to charge a higher interest rate for that. So to keep the low interest rate and get the money, cash out mortgages are often a better way to go.
Got it.
So it is still happening just because of all the equity people have in properties these days.
Just two more quick questions from some of our listeners. Does Nevada State Bank do VA loans?
Of course, yes, we do all kinds of loans.
And how often can someone that's eligible use their VA loan?
Ultimately, a VA loan can be used over and over and over again. It depends on the person and their eligibility because that's looked up on every VA loan, but you cannot use your VA loan at the same time more than once. So if you buy a home and use it as your primary residence and then you sell that home, you've now freed up your VA loan to use it again. You cannot use it on your primary residence and then say, oh, hey, I want to use my VA again and go buy a second home. So you can only use it once at a time.
Got it. And feel free to talk to your lender and
yes,
figure it out.
I'm far from a VA expert, but that is definitely, VA is a phenomenal program, especially because the limits on that have increased along with the conforming limits versus an FHA loan has much lower limits than a conforming loan.
Next one. When will interest rates go up?
Tomorrow, every day. This is obviously the crystal ball that there's no way any of us can really know. The Fed, meets up to 8 times a year, and they are always evaluating the information that's happening. And that's how they determine if they're increasing the Fed rate, which, as we already said, does not directly impact mortgage, but indirectly does. So your guess is as good as mine, but they are saying that we could get up to 7% on our 30-year fixes, I don't know, by next year.
That's right. Better get out there and buy.
I was going to say, do it now before they go that high.
And last but not least, have you been up to anything fun lately in Vegas? You got a favorite restaurant? Any favorite activity?
I am I'm a family lady. So I have one very young kid and I have one teenage daughter. And one of the things that I think people who don't live in Vegas forget is that we have normal lives here and we have a lot of things that we do. And so my time is spent, my daughter does competitive cheer. So we are very consumed with that. It's a lot of fun to see her. And then I have an 11-month-old son. So we're doing these crazy ISR classes, which I highly recommend for anybody, especially in Las Vegas, because there's a lot of pools, but teaching an infant to swim. So family stuff, but It's really fun. It's the cool things, normal life.
And it is pool season.
It is pool season, pool safety.
Well, enjoy.
Thank you so much.
You're welcome.